Sorry for the bunged up voice and nose. I'm a little bit ill this morning, so apologies for that. So please bear with me. Um, so before we actually get into the bulk of today's presentation, I just want to direct you to this ebook, which I will be handing out after this webinar or during the webinar. So if you guys email me on Zaheer at zaheeranwari.com. So that's just my name, Zaheer at zaheeranwari.com. I'll be sending this ebook out to everyone, and it's actually written by Anne Chapman. This is the lady that taught me how to trade back in 2007. Just to give you a brief background of myself, I come from a background of IT, so I've got a degree in software engineering. I worked for a year for a company called Oracle, which I'm sure a lot of you guys are familiar with. I worked for about a year as an SQL programmer, and I left. And the reason why I left was I realized that if you're going to be in a 9 to 5 of sorts, you've got to make sure that you enjoy what you're doing, because it is pretty much the bulk of your day, and not just your day, your week, and pretty much your whole life. 9 to 5 tends to take over. There's nothing wrong in a 9 to 5, and for those of you guys who are trying to avoid going down the route of a 9 to 5 and just go straight into trading, unless you're in a financially strong position, and what I mean by that is you come from a background of wealth, or you've been given a lump sum of inheritance money or something along those lines, unless you've got a decent amount of money to get started with, you're going to find it very difficult to get any money from trading. So you can't go down the route of trading to avoid the 9 to 5. You need to be part of that to have a salary coming through that you can then leverage through trading. That is the real strength of trading. So I realized that if you're going to be part of the 9 to 5, then you're going to make sure that you enjoy what you're doing. And I had no interest in programming at all. So I then became an English teacher. I lived out in Taiwan, Japan. I was out in Asia for a couple of years with a TEFL qualification, teaching English as a foreign language. I'm sure you guys have heard of this. Had a lovely time, came back to London, and then became a photographer. In photography, I was in the industry for about 5 years, loved it, made a fair amount of money on a regular basis, and it was really during this sort of journey of mine that I started turning to trading. Now, the main reason why I turned to trading was because I was fed up of compromising. In IT, I was compromising my passion. I had no interest in IT. In English, teaching English, lots of fun, traveled, met a lot of interesting people, but there's no money. In photography, the money was good, the traveling was good, but the hours were horrendous. I was working 15, 16 hours a day. So there's always something being compromised. And I started questioning that. I'm naturally a very curious person, and I'm actually quite rebellious. So having that combination is what really took me down the route of trading. Now, the route of trading that I went down was very, very specific. If you go online now and you start looking into trading, pretty much every route and website and tutorial or seminar, if you like, that you go down is pretty much based around day trading and scalping. That's pretty much the bulk of the industry that we're in today. And that can work, again, if you've got a good amount of money to get started with, that can work. But the problem with day trading is that there's a lot of compromises that come with it. First and foremost, the time that's involved. As a day trader, you're glued to the screen for several hours a day. And if you're already in a 9 to 5 lifestyle, if you've got a family, if you've got kids, if you run your own business, if you're traveling a lot, day trading is not the way forward. What you want is a style of trading that can be adapted around your lifestyle in as minimal time as possible, but without compromising on profit. This is the crucial aspect that I must really stress upon. You want a style of trading that can be adapted around what you do without compromising on profit. So if you think about it, you're not compromising on time, and you're not compromising on profit. And this started resonating with me because that's what I was looking for. So during my journey, what I was looking for was empowerment, not just the money, but also time. Because ultimately, when you get older, I'm 37 now, money is important. And the money that I generate from trading funds my lifestyle. But what I really enjoy from trading is the time that it gives me. And you're not going to get that from day trading. You guys have to step away from the lower time frames. If you're on the 5-minute time frame, the 1 hour time frame, you need to start looking up. You need to start looking at the daily. You need to start looking at the weekly. You need to start looking at the monthly. And there's many, many, many benefits with this style of trading, which I'm going to cover during this webinar. So to get you guys started, to really start understanding how to think in terms of what I call myself a trend trader, we have this amazing ebook written by Ann Chapman, and it's a 60-page ebook. It's not a good 10-page ebook. It's a 60-page ebook that covers the real foundation of trading that you must have. And this is where a lot of people go wrong. The statistics are very real, guys. We know that only 5% of private traders succeed, and this isn't down to anything other than a lack of understanding of what people are doing. There's nothing particularly special about me. I'm an everyday person, but what I did was went down a route of knowledge, foundation, understanding what I'm doing even before I executed a trade. What most people do is go straight to a broker, fund an account, and start trading with whatever free knowledge that they find on the internet, and then question why they're not getting success, why they're not succeeding, why they're making money losing it, why there's a lot of stress involved, and ultimately why a lot of people blow trading accounts. In almost 10 years of trading, I have not blown a trading account. It's an unnecessary part of trading. So you've got to start questioning your approach, and this ebook will really start helping you guys. Something as simple as understanding the difference between the bias and the trend. If you try and explain, if I have a conversation with a trader, it's one of the first questions I ask them, which is like, what's the difference between your bias and your trend? How do you define that? And if they cannot define what the difference is between their bias and their trend, I know that the foundation that they should have is missing. Simple questions. I can know within a minute whether someone who says that they are trading, it's a very loose word, I'm a trader. I like to play football. Doesn't mean I'm a footballer. For me, if someone says to me I'm a footballer, that means that they've got a contract, they signed for a club. It could be semi-professional, maybe to a certain extent. But if someone says to me I'm a footballer, to me that sounds like you're making money from football. But if you say to me I like football and I play football, that's someone who enjoys kicking the ball around. You guys have to start thinking along the same mindset. If you call yourself a trader and you're just because you're in front of the screen and you've got a broker account and you've got a bit of software, are you really a trader, or are you simply learning to trade and you're allowing the ego and the mindset to come in? If you start approaching the markets with ego, you're going to get burnt. Okay, so you guys have to start stepping back and really start looking at the foundation that you've got. This ebook will help you, and it's totally free, guys. I'm sending this out. If you scroll down, or if I scroll right down rather, you can see every chapter comes with diagrams, fully loaded with a lot of juicy information and detail. Okay, so if you send me an email, guys, it's easier, of course, if you send me an email. In the subject title, put RTCT, so round the clock trader ebook. If you put that in the subject title, I will have this over to you ASAP. Okay, now some of these concepts we are going to cover in today's webinar. So I'm now going to move over to the software that I use. Now, the software that I use, guys, is eSignal, esignal.com. Now, whatever I present during this webinar, if I talk about software, if I talk about brokers, one thing I want you guys to be very aware of is that I'm not associated to any company. So I'm not going to get a kickback from introducing anyone to eSignal. I'm not going to get a cut from any of your trades that you may place because I've recommended some kind of broker. Anything that you see in these webinars and anything that I present is purely informational. It's advice. It's the way that I recommend private traders should move forward with their trading. Yes, it will involve a cost, but this is a business. And if you don't view it as a business, if you don't give it the love and the investment and the time that it deserves, then you're not going to be rewarded. So I know that pretty much all of you guys will be using free software. It will be software either provided by your broker, it will be software maybe like MetaTrader or NinjaTrader. I don't know. There's lots of these different softwares that I know are free. I haven't used them, but from speaking to people, I know they're free. It's not what I use. What I use is eSignal. Now, eSignal is a paid-for platform. It's not expensive. In fact, we get our community members a very, very, very good discount. You're looking at around $40 a month. And this is for foreign exchange data, US data, US stocks data, UK stocks data, commodities, for around $40 a month. Now, the advantage to this is that the data is independent of any broker. And secondly, it allows for high-end tools to be developed that can work within the platform. So as a dynamic trader, which is the community that I'm a part of, I'm blessed to have been given a whole patch of tools that have cost around 100,000 to develop. So if any of you guys know anything about software development is not cheap. The tools that I've got have cost over £100,000 to develop. I'm going to be sharing some of these tools in this presentation, just to show you guys what takes hours a day for people that are using free software literally takes me 10 to 20 minutes a day, meaning that it can be adapted, going back to what I was saying, adapted around my trading, my day-to-day lifestyle. Okay, so let's get into this. What you can see is a typical chart setup of mine. Top left corner is the watch list. Notice it's an extensive watch list. Aussie dollar, US dollar at the top, and it goes all the way down to the South African rand, Japanese yen. I also trade stocks. I also UK stocks because I'm here in London. I also trade UK stocks. I trade US stocks. I trade commodities. Those are my 4 markets. I don't limit myself to one market, and I don't limit myself to a single currency. You speak to a lot of people, they only trade the euro dollar. They only trade gold. They become experts on one instrument. That's not how to do it. You want to have a big portfolio and then narrow down to where the money is. The money is not always going to be on the euro dollar, and I'm going to show you why. Okay, the way to look at this is like a hawk. If you think of a way a hawk hunts for food, a hawk will hover miles above ground, and then when it spots its prey, which may be a rabbit or some kind of rodent, it will swoop down, eat its food, catch its prey, have a feed, and then go back up again and then hover again. If the hawk was hovering at ground level, it will only be able to see what's directly in front of it. And that's the mistake that a lot of traders make. They're hovering at ground level and they're looking at what's directly in front of them. If you step back and you look at the bigger picture, you will spot far better opportunities on the horizon, making it a much easier process to manage a watch list, to build a portfolio, and to generate consistent returns. If you're just trading one instrument or even like a group like the majors, you're going to be struggling. So I'm going to be showing you how I manage a watch list, because usually when I show people this watch list, they panic. And the first thing is, how do you manage such a big watch list? Well, I'm going to show you. Right, top right corner, monthly, bottom left corner, weekly, bottom right corner, daily. Instantly, I'm looking at the bigger picture. What I'm looking for are trends, long-term opportunities in the market. Now, the obvious argument, which I hear all the time, is, well, trends appear on the lower time frames. Yes, that is correct to a certain extent. Let's break down what a trend is. A trend, and a perfect way to define a trend, is fashion. The minimum time that you would expect your item to stay in fashion is a period of 3 months. Now, the reason why I say that is because fashion is seasonal. You have summer fashion, winter fashion, autumn fashion, spring fashion. Every 3 months, the seasons are changing, and the fashion changes with it. Now, of course, we then talk about fashion as periods as well. So we often talk about 60s fashion, 70s fashion. So we're talking about decades. Look at the mohawk that David Beckham did. It was in fashion for a long period of time. Look at beards today. Look at the hairstyles that people have, even women with shaved heads and lines. You know, these fashion statements aren't in play for a few minutes or a few hours or even a few days. They're in play for periods of time. If you paid £2,000 for, let's say, a nice tailor-made suit, or £1,000 for a high-end pair of shoes, and an hour later the shop phoned you up and said your item of clothing is no longer in fashion, you need to come back and buy something else, you're not going to be too happy. So you want to view your trading in the same way. If you are in and out of trades in a few minutes, then, you know, I personally would not be happy at all knowing that I can stay in trade for months. In foreign exchange, I've held trades for 8 to 9 months. In stocks, over a year. And I'm going to show you examples of how I did this. Now, the reason why people tend to hold trades for a short-term period is because they're trading on lower time frames, and there's this idea that money is made by being in and out of trades, multiple trades on a daily basis. What you want to do is you want to get away from that logic. You don't want to be thinking in terms of having many small winners. What you want to be thinking about is having a few large compounded winners. Think Warren Buffett, think George Soros, think Jim Rogers, think the Turtle Traders, think Jesse Livermore, think John W. Henry, right? Think Curtis Faith, think William Eckhart. These are the guys that made substantial amount of wealth as individuals. And these are the guys that you want to aspire to be like. Okay? So let's move on. Let's move to the Aussie dollar, US dollar. Let's look at the monthly time frame. Now, the monthly time frame is where I look for very clear areas of support and resistance, and where I start developing a bias in the market or an edge. Now, what do I mean by this? In trading, nothing is guaranteed. We know that. When you enter into a market, nothing is guaranteed. Anyone who tells you that they know what is going to happen next because they understand news or because they understand the personality of a currency is talking a load of rubbish, because it's a fact of the market that whatever happens next is totally out of our control, especially with the noise that is happening on a lower time frame. And again, this is a fact, guys. The lower down you go, the more unpredictable price becomes. The larger time frame you use, so the higher time frame you go, the more predictable price action becomes. The more predictable doesn't mean it's guaranteed, it's more predictable. So the personality of any instrument is clear on the larger time frames. If you look at the monthly time frame, you'll get a much clearer idea of what a currency or a stock moves like than on a lower time frame. So you want to get away from thinking in terms of I know what is going to happen next, or I knew that was going to happen next. Everyone's an expert in hindsight. But the reality states that very, very few people are consistent with trading. Get away from looking at people who are putting their winning screenshots on the internet. If you're showing your winning trades, then you're hiding your losing trades. It's a pretty obvious logic. Okay, so we want to be more mechanical, we want to be more robotic, and we want to be more professional and business-like with the way we approach the market. The first thing you guys must learn to do is develop an edge. This is an environment where you have more chance of making money than losing money. If you cannot define your edge, you don't have one. And if you don't have an edge, you'll get eaten by someone who does. Very, very clear fact of the market. So how do we start developing an edge? The first thing I like to use are these pink lines. So you can see here, guys, we've got these pink lines. Now, what do these pink lines represent? They represent the high, the low, the close of the previous calendar year. So January to December 2015. As we're coming towards the end of 2016, when 2017 starts, these pink lines will automatically adjust to give me the high, the low, and the close of 2016. At the moment, this represents 2015 as we're in 2016. When 2017 starts, this will automatically change to give me the high, the low, and the close of 2016 this year. Just to show you how quickly my software works, show only current period. If I uncheck that, I get all of these levels for previous years. I'm not interested in that because it makes my chart look messy. I only want to know the levels of last year. So I will keep this checked. Now, how do I use this? Well, the logic is very simple. If price is trading above, sorry, I'm just trying to grab the pen. Can't seem to grab the pen. Why can't I do the pen? Okay, bear with me 1 second. Looks like the go-to me. Here we go. Oop, that wasn't correct. All right, how do I use these pink lines? Well, if price is above the pink lines, then price has a bullish bias, and I'm looking for long opportunities. It prices below the pink lines. Price has a bearish bias, and I'm looking for shorting opportunities. If price is inside the pink lines, like the Aussie dollar, US dollar, I stand aside. I'm not looking to trade it. Okay, so again, it's a very, very simple rule. Remember, trading, the best rules in trading are simple. Trading is simple but not easy. So let's look at the rest of the watch list now based on that logic. So anything that is inside the pink lines, I can dismiss. Aussie dollar, Canadian dollar, inside the pink lines. Aussie dollar, Swiss franc, inside the pink lines. Aussie dollar, New Zealand dollar, inside the pink lines. Canadian dollar, US dollar, Canadian dollar, inside the pink lines. So you can see that anything that's inside the pink lines, I may look to dismiss. If they're in trend, then I may reduce my risk. So full allocation risk is 2%. If I have a good trending instrument inside the pink line, I will reduce my risk to 1% or 0.5%. Sometimes you want to go with what the trend is telling you. Because remember, the bias and the trend are two different things. So let's have a look at some of the currencies that I have been trading recently. Euro pound, above the pink lines, bullish bias. I was long on it. Pound dollar or pound Aussie dollar, below the pink lines, bearish bias. Pound New Zealand dollar, below the pink lines, bearish bias. So you can see that by having these pink lines on the chart, I know exactly what should potentially be on the watch list and what shouldn't. Euro dollar, inside the pink lines. It hasn't broken out. If it breaks out to the downside, like it looks to be potentially doing, then I'll start looking for shorting opportunities. But for now, I have not traded the euro dollar since March of 15 rather. The last time I traded it was this bear trend, where I had 5 positions running, and this 3,000 pip move, by the time I exited from my positions, which I'd held for 8 to 9 months, I had exited with over 16,000 pips. So a very profitable trend. Okay.
So
Now,
here,
yes. Hi, Simon.
so I'm going to just interrupt you. We've got quite a few questions starting to come in.
Okay,
Um,
fantastic.
and we could address before we get too far forward.
Yes.
Just for a minute or so. Marin asked a question about the e-signal platform.
Yes.
Uh, does it allow you to write your own code?
Yes. If you know how to code, then yeah, sure. But it uses JavaScript.
Okay. Well, there we are. That's an answer. Do you trade indies? I wonder, Andre, if you mean indices, or I'm not sure what you
Uh,
mean by indies. I think it might be indices.
okay. Well, the answer to that is I don't trade the indices. I trade the individual stocks that make up the US stock market. I use the indices as a guideline to tell me whether the market is bullish or bearish or within the pink lines. So it's a
Oh,
guide. The indices are a guide.
gotcha. Now, Ivan, his internet stopped for a while, and he thinks he may have missed something. This is regarding the charts we're looking at. He says, how do you define the HTEPH lines?
HTE HTEPH. What? I'm
P.
sorry.
I'm
That
not
doesn't.
sure either. Ivan, maybe you can expand on that. Let's move on. Why, Ivan, maybe the pink line. Oh, he means the pink lines.
Oh, okay. The pink lines are simply the annual levels of the previous calendar year. So that's the high of 2015, the low of 2015, and the closing price of 2015. These pink lines are all explained in the ebook. So if you email me on Zaheer@zaheeranwari.com, I'll get the ebooks out to you.
Okay. Marin asking the same question about the middle pink line. That's the average, is it?
No, that's the closing price of the year. So December
Of the year.
31st, 11:59 p.m., 12 a.m. when the new year comes in, January 1st. That's the closing price of the year, which is the opening price of the new year.
Okay. Got you. What about volume? Does that play a part in your trading?
Yeah, in stocks, there is no volume in currencies.
Hmm.
Because currencies are traded from a central exchange. It's pretty much impossible to know the volume involved. What you
Yeah.
do is you replicate volume using ATR. average true range. So if you know the average true range of a currency, then you can replicate volume using ATR. But for stocks, you have volume. Yeah, and definitely. I look for stocks with over 1 million.
Gotcha. One final question before we move on. Alan, Tez, you mentioned that e-signal data costs around $40 a month. Is that for the real live time data or the delayed data?
It's a good question. First of all, the $40 a month is if you go through dynamic traders. If you go through eSignal platform, you're looking at around $150 a month, and that is for the $150 a month is for live data. The $40 a month is delayed data, but it's only delayed by 10 minutes. So if you're looking at the larger time frames, the monthly, weekly, and daily, a 10-minute delay has no impact on your trading. I use live data, which is a lot more expensive, but many of the members who I train, our community members, they pay $40. A 10-minute delay, we don't day trade, so it has no impact.
Gotcha. Great. Zaheer, thanks for that. Okay, we'll carry on. How are you doing? You surviving?
I am surviving. Apologies if I'm sounding really bunged up, but yeah, all good. All good. Thank you,
Yeah,
Simon.
no problem, no problem. Good on you for
Soldiering on.
soldiering on. That's it. Okay, back to you, Zaheer. Thank you.
Thank you. Yes. Okay. Fantastic. All right. Great questions. So let's move on now. The next point that I want to highlight are support and resistance. These are what I consider the major levels of support and resistance. You must have very clear rules when it comes to trading. If I say to you, guys, okay, see that line, that's clearly a support line or a resistance line on your chart. Explain the logic behind that. If you cannot explain that logic to me and it's something that you feel is a good support or resistance level, that again is it's gambling. You want to have clear, defined rules. We as private traders are at a massive advantage. Why? Because we don't have the rules and regulations that institutions have to follow. We're at a massive advantage. But this is the downside to most private traders. Because we're in a lawless environment, because every person that comes into the market is an alpha, it's very difficult for traders to create rules and then follow the rules. What you want are rules that work. You want proven rules. You don't necessarily need to go down the route of trying to figure this out yourself. I had no time or inclination to figure things out myself. I'm very, very, very lazy. I want someone to sit down next to me and show me this is what you do. And I've always been like that for all the things that I've learned since I was a kid. Forget trading for a second. Everything that I've ever tried to learn doesn't necessarily mean I was any good at it. I tried to learn the guitar. I was pants at it. But I did it one-to-one. I paid for one-to-one tuition. So everything that I like to do has been from a point of A, being lazy, because I really can't be bothered to try and figure things out myself, and B, being quite greedy and selfish because I like one-to-one tuition. But because of that mindset, I've allowed myself to be quite successful at trading because I've approached this the right way. I wanted rules that worked. Support and resistance are fundamental to trading. People sometimes don't realize how important they are. Price is your main indicator. Everything that you do should be based on price. Too many people looking at subchart indicators, MACD, RSI, stochastic. These are all lagging indicators, guys. They're lagging. You cannot use lagging indicators to try and give you an advantage as to what price is going to do next. Lagging indicators confirm what price is going to do next. You cannot use it to predict or dictate or try and guess what what the market is going to do next. It's a false economy. Price will tell you that. It's your main indicator. You then want support and resistance as your leading indicators. Once you understand levels that price can move towards, you can then understand how long you could potentially be in a trend for. And then you want to use moving averages as your lagging indicators, which we're going to cover in a second. Moving averages are great to confirm what price is going to tell you, what price is confirming it's going to be doing. So moving averages are fundamental. Support and resistance as your leading indicators, price as your main indicator, the moving averages as your lagging indicators. That's what you need. Clean, clear, and simple. These red and green lines, they are support and resistance levels, major pivots. How do I define them? High bars and low bars with a minimum of 10 bars on either side. Again, explained in the ebook. major pivots with a minimum of 10 bars on either side, this software will automatically detect and start plotting. So as soon as we get a new major pivot, the software will automatically start drawing green and red lines. Think about it, guys. On your free software, you're all drawing support and resistance lines manually. How long does that take? It's a time-consuming process. And because it's so time-consuming, you have a small portfolio and a small watch list because there's too much time involved. Now start adding in five to 10,000 stocks that you could be potentially trading. It's a lot of work. Because you're not investing in good software, you're compromising your time. And this is what I mean by the fact that having good software will empower you with both. You don't want to compromise. We compromise day to day in our lifestyles. The system we are a part of is all about compromising. When you come to trading, there should be no compromise. Okay, now beyond these major pivots and the pink lines, I look at round numbers. So on this particular currency, what am I looking at? Well, the euro dollar, we have 1, 0.9, 0.8. If we go up, 1.6, 1.5, 1.4. Now, the way to look at round numbers is very simple. Imagine if you are jogging. When you are jogging and you get to 10 kilometers, let's say, when you reach 10 kilometers and you're feeling quite good, in your head, you're thinking, well, I could make it to 15 kilometers or 20 kilometers. Those are psychological levels, those strong round numbers, if you like, where psychologically you want to move towards, but it doesn't necessarily mean you're going to move to that. So when you start jogging beyond 10 kilometers, you hit 11 kilometers. You go past 11, you think 12. Okay, by 12 kilometers, you're now starting to tire. But you're beyond 12 kilometers, 12.2, 12.3. In your head, you still want to make 15 kilometers, but by the time you get to 13 kilometers, you've had it. But at least you made it to a round number. You're not going to stop at 12.4 kilometers. You're going to get to 13 kilometers because psychologically, that's what human beings do. Price does the same thing. And to prove the fact, look at this high point, 1.6. Look at these two levels, approximately 1.5. Look at this high point here, 1.4. If you look at this whole floor, 1.2. If you look at where price is currently in a consolidation, 1.1. The lowest point on the chart, 0.8. Round numbers. And this is what I mean by price being predictable to a certain extent on the larger time frame. If and when price breaks this support level, the first level is 1. Then 0.9, then 0.8. So once I'm in a trade, I hold my trades to these levels. So once I start shorting, I'll be holding my positions till 1. If it breaks 1, I'll be holding it to 0.9. If it breaks 0.9, I'll be holding it to 0.8. Now, there's always a chance it will come to 0.9 and bounce up, but that's where my trailing stop losses come in. So I don't work on a risk to reward of 1 to 1 or 1 to 2. Too many people having fixed risk to reward. You've heard the expression, let your winning trades run, cut your losers short. My risk to reward is not 1 to 1 or 1 to 2. My risk to reward is 1 to infinity. Why? Because I allow my positions to run for as long as the trend is in play. And not only do I allow my positions to run, I repeatedly compound. So as and when I get new entry points, I keep on adding to that particular position. So for the people who are unfamiliar with compounding, this is essential, and these are the things that you must understand. And this is why day trading is very unnecessary. Because let's say if I'm long on this particular trend, as it starts developing, I start adding new positions. So you can see, let's say a move of, I don't know, a distance of around 3,000 pips. The first position runs 3,000 pips, the second 2,500, the next 2,000, the next 1,500. So a 3,000 pip move can add to thousands of pips through compounding. And this adds fantastic percentage growth in a few months. And I'm talking significant percentage growths. A single trend, guys, can return you 20%. A single trend. If you have 3, 4, 5 of these in foreign exchange, if you have 2, 3, 4 of these in stocks every year, you may have one in commodities like oil. That is how you're going to grow an account. Okay, and think about the time involved. Going back to what I was saying earlier, you've done very little work to achieve this growth. You've all done it in minutes a day. Right, the weekly and the daily time frame. What do I look for on the weekly and the daily? And this now goes to moving averages. I look at the 200 simple moving average and the 50 simple moving average. So that's on the weekly. And I look for exactly the same setup on the daily. I've got the 200 simple moving average and the 50 simple moving average. Now, why the 200? The 200 is an indicator where the logic has come from before the internet. Since the creation of the internet, guys, and since the creation of software, private traders have been driven down onto lower time frames in the promise of quick riches. The best techniques are proven techniques that come from before the internet. And this language, this logic is being drowned out because it's so powerful. The 200 simple moving average comes from before the internet. Why? Charts were drawn by hand. Old school traders used to calculate and draw charts by hand. So they were very selective with the information that they put on their charts. The 200 simple moving average was a proven indicator of the long-term trend. It gave them the overall bias of the market. If price was above the 200, the bias would be bullish. They would look for long opportunities. If price was below the 200, the bias would be bearish. They'd look for shorting opportunities. What you're then looking for is alignment between the weekly and the daily. So the way to look at this is weekly is big brother, the daily is little brother. So if big brother is above the 200, you want little brother to be above the 200. If big brother is below the 200, you want little brother to be below the 200. You want little brother to be following big brother. This is where we're looking for trend alignment. And for these setups to appear, sometimes can take time. And it's that element of patience of allowing a trend to present itself where people struggle. People want to make money every day because of the way we're programmed to make money hourly, weekly, monthly, like a salary. And people bring that same logic to trading. In trading, money is made in periods. You can make very, very good profit in 6, 7, 8 months, but then you may make nothing for 3 months. And it's that holding of 3 months and making nothing where people panic. But what people fail to realize is that when one market is quiet, i.e. foreign exchange, stocks will be in trend, or commodities will be in trend. So the money has moved from one market to another market. If you're just focused on foreign exchange, you're going to struggle. I'm going to show you some stocks. In fact, my best performing instrument of this year is a stock. It's not a currency. Hi, Simon.
So here,
Coming
in? Yes. Again, we've got lots of questions coming through, which is fantastic. I just want to make sure we can try and stay on top of them before we get too far. George, he makes the point that using daily, weekly, or monthly charts, the lagging indicators are not much of a problem. But he goes on to ask, what do you do with your open trades during a consolidation or a pullback period?
Okay, yeah, it's a really good question. The answer is I hold. So let me give you an example. And I'll do that right now. So if we look at Nvidia, so Nvidia is my best performing instrument of this year. I've been long on Nvidia since $40, and you can see that this is just below $100. Again, showing you psychological levels. Now that this is looking at the monthly time frame. The monthly time frame paints a very beautiful picture. But if I go down to the weekly time frame, you can see that the trend has these little pullback periods. And it's in these little pullback periods where people panic, but this is where you hold. And if we go to the daily time frame, here is that same trend. Now, what I didn't cover, which I was going to cover, is the 50 moving average. The 50 moving average acts as a proven level of support and resistance. And to answer the question, look at how it's bouncing off the 50 moving average. So during pullback periods, you hold. And every time it breaks out, you compound and you add a position. Embrace pullbacks. They're part and parcel of the trend. If you don't embrace them, you'll never grow an account. You won't see consistency because every time the market starts moving against you, you panic. But this is where what people fail to understand is that trading has its own set of skills. One of those skills is applying patience during the pullback periods. If you don't know how to apply patience and be emotional and remove yourself from the market, you won't be able to hold trades for months at a time. And you'll always be in and out. You'll have winning trades, you'll have losing trades, and they just cancel each other out. So to answer George's question is to hold. to be patient and wait for the breakout. The likelihood is that the breakout is always going to happen in the direction of the trend. When you've got your biases all aligned, when you've got your edge, the pattern will repeat. You allow it to play out.
Okay, thank you, Zaheer. Okay, now moving on. Ray says, what is your trigger for entering and exiting a trade?
Entering into a trade is a breakout or a pullback. So depending on what kind of market structure I'm in, I'll trade either breakouts or pullbacks, which I'm going to cover because I haven't gone into that as yet. And exiting is based on trailing stop losses.
Okay, wonderful. Now, shall we, probably not pronouncing your name correctly, apologies for that, but you make a good point when you say, don't you need large starting capital to hold positions for months and to
Yeah,
compound?
it's a common misconception, and that is why people are day trading, because again, they haven't taken the time out to research and understand and find the correct answers. It's a very common argument that you need to have large capital. First of all, you've got to be in the right place financially. If you don't have money to start with, you're not going to generate money. That's pretty much a given. So you want to have a job, you want to have a salary coming in. To actually start trading this way, you only need to have £2,000 to £3,000 or dollars or euros in a trading account, and you want to be using micro lots because then you can position size correctly. Now, having a £2,000 or £3,000 trading account, I understand what people are going to say is, well, yeah, how much profit am I going to make from that? Well, it's a slow and steady process. You've got to add money from your salary. You've got to grow it. You've got to add. You've got to grow it. The more money you have, the more your growth. You've got to have a time plan like any other business. 2, 3, 4, 5 year time plan. If you're going to try and achieve this growth of a £2,000 or even a £10,000 account to 100,000 or a million in 6 months to a year, guys, let's be realistic. You're looking at you're trying to get 1,000% growth in a few months. Warren Buffett makes 20% a year. Got to be realistic.
Okay, good point. Elizabeth says, Zaheer, can you repeat the big brother, little brother analogy?
Yes, sure. Big brother is if the weekly is above the 200 moving average and the 50 moving average, like on this currency, then you want the daily to be doing the same thing. So you want the daily chart to be mimicking the weekly chart. If the daily chart is not mimicking the weekly chart, then you want to do two things. A, either stand aside, or B, if it's looking interesting, you can reduce your risk. So instead of having a full 2% allocation, you can allocate 1% or half a percent.
Okay, well, let's carry on because I'm conscious of the time. It's about 9:45 now, so I'll let you carry on. So
Great.
we can.
How long do I have, Simon?
You got about another 15 minutes.
Okay, brilliant, fantastic. Enough time. Okay, so to answer the question that has just arisen, is how would I get into this? So for you guys that are not in this, how would you get into this? First of all, don't fear the fact that it's moved so much. A lot of people would look at this and say they missed the trend. No, you haven't missed the trend. You've missed this section of the trend. If this clears $100, then this may move to 110, 120, 130, 140, 150. You don't want to predict the reversal. You want to predict the continuation, or you want to, you don't want to predict the reversal. You want to let price dictate the reversal or the continuation. Now, it's very simple, guys. These are the rules of trading. Rule number 1, find your edge. I've already explained to you my edge. You will have picked this up. A bit above the pink lines on the monthly, above the weekly 200, above the weekly 50, above the daily 200, above the daily 50. That is my edge. That is my 5-point criteria for a bullish environment. For a bearish environment, below the pink lines, below the 50 and the 200 on the weekly, below the 50 and the 200 on the daily. That's my edge. Once I have my edge, I need to look for an entry. Once an entry presents itself, I place a trade. Very mechanical, very methodical, very well thought out, unemotional, no panic, no second guessing. Once the edge and the entry point presents itself, I place a trade. I have a well thought out entry. I have a well-placed stop loss, and I risk no more than 2%. I then let the trade play out. Once I'm in the trade, it either is a winning trade or a losing trade. If it's a losing trade, I lose no more than 2%. I still have 98% of my capital. If it's a winning trade and it starts returning me a profit, I buy more. I compound. I compound, I compound, I compound. As the trend develops, I use a trailing stop loss, and once it reverses and hit my stop loss, I cut out. And round and round and round and round we go. That is what trading is about. Developing an edge, finding an entry, taking the trade, letting the trade play out. If you're risking 10%, 20%, it's going to be a bumpy ride. If you have no edge, it's going to be a bumpy ride. If you don't have stop losses, it's a bumpy ride. If you don't know how to hold positions, you're not going to grow an account. Okay, so looking at NVIDIA, and this should ask the question, I think it was George. No, a gentleman, I can't remember, a gentleman who asked about how would I enter. First of all, you want to see 100 clear. Once 100 is cleared, you then want to allow for a retest of 100 and the next breakout. So you're looking for, if this level here, just grabbing the pen, let's say this level here was 100. So what you had was price break 100, retest 100, and you're now waiting for the trend to continue. Of course, price does that. When it does that, at the moment, it's just consolidating. This is where I'm holding. I've been in this since $40. I'm not ready to cut out yet because the trend hasn't come to an end. The trend will come to an end when the market dictates. Okay, so let's have a look at some of the currencies that I am in. So first of all, Turkish lira. US dollar, Turkish lira. Above the pink lines. So we are bullish. We're above the round number 3. And look at where this consolidation period was. Round number 3. If you look at the history, long period of consolidation. So 2002 to 2013. The bigger the consolidation, bigger the breakout. So this has been trending since 2013. Nice trend, consolidation at the round number 3. So now that it's above 3 and above the pink lines, I'm looking for this to move towards 4. Weekly, above the weekly 200, above the weekly 50. So bullish bias and a bullish, and the 50 acting as a support level. And you can see a nice trend to the upside. And if we go to the daily, above the daily 200 and above the 50. So we have alignment, monthly above the pink lines, weekly above the moving averages, daily above the moving averages, and we have a trend in play. Now look at what it's doing. It's simply going through an area of consolidation, a pullback, a breather, because that is what the market does. It doesn't continuously shoot up in a straight line. What people want is instant gratification and they want lots of money. No, guys, a trend is a function of time. If you eliminate time, you eliminate the trend. If you eliminate trend, you eliminate profit. Okay? A trend is a function of time. I'll repeat that. A trend is a function of time. If you eliminate the time, you eliminate the trend. And if you eliminate the trend, you will eliminate profit. You will eliminate growth. And this is simple. Guys, since I've entered into this, I've simply allowed this position to run. It's in profit. Yes, it's gone through a correction, but what I'm now looking for is a breakout of this high point. Once I get a breakout of this high, I'm going to add another position. And I'm going to repeatedly do that until I get to 4. And when it clears 4, I'll compound to 5. If it clears 5, I'll compound to 6. Okay, next currency is the US dollar Swedish krona. Okay, if I take price action back, this was the last time I traded this. A nice bullish trend, several months. Look at where it failed, just below 9. Went into consolidation. When the market consolidates, look, inside the pink lines. What I'm looking for is a breakout. As the trend prior to the consolidation was bullish, we favor a breakout to the upside. That's what we've had. Now, what do we need to do? Well, we need to be patient because we've got a resistance level here from 2009. If it clears this resistance, I'm going to start looking for long opportunities. The weekly, above the 200, above the 50. The daily, above the 200, above the 50. If we look at the daily, we had moved to the upside. It failed at that level. Price failed at that resistance level right here. and it did a pullback. Look at where it pulled back to, 9, round number. So after every break, it likes to retest. Now we're starting to see a bounce to the upside. Guys, this is natural market movement. If you fail to embrace the natural movement to price, you're going to struggle. Look at where else it came to, the 50. So the 50 moving average and the 9 clustered together as a support level. We're now looking for a bounce to the upside. If it clears this high, we can start looking for long opportunities. You do not want to be shorting this. You want to be allowing the trend to continue and entering long. This is where patience comes in. And the thing is, while I'm waiting for this to set up, I'm already long on the Turkish lira. I've already got stocks in play. That's UK stocks and US stocks. So I don't need to be too engrossed with this because I've already got profit coming in from other instruments that have already set up. This is where the art of managing a watch list and building a portfolio comes from. Knowing what to trade when in trend, knowing when to let go when the trends end, knowing where to go when new trends appear. This is all part and parcel of being a trader. You cannot expect to just make 10% a month just day trading the euro dollar. It doesn't work. It may work for 1 month, but then the following month it doesn't. But it's because of that one winning month that you've had, you're fixated on that idea that it's going to happen again. But you're totally missing the bigger picture, which is the inconsistency of it all. Okay, let's go to the euro dollar, because the euro dollar is currently something that I'm keeping an eye out on. It's still inside the pink lines, but we can see there's momentum to the downside. Trend prior to this was bearish, so we want a breakout to the downside, and we've got plenty of space for that trend to develop. Weekly, below the 200, below the 50, daily, below the 200, below the 50. Now, one thing I forgot to mention, guys, is if you look at the angle of the moving averages, they're heading down. This is what I mean by confirmation. If price is heading down, we want the moving averages to be heading down. If I compress this chart, look how flat the 200 and the 50 are in this period here. Here they were in trend. The moving averages were heading down. Price was in trend. And then when the market started consolidating, look how flat the moving averages became. Very clearly telling you the market's in consolidation. Now that the market's starting to move down, the moving averages are starting to hook down, but we still need to see this low point cleared. When this low point is cleared, that's when we can start looking for shorting opportunity. While this sets up, we stand aside. Okay, and just to show you how I apply this logic to stocks, a stock that has returned me good profit is Boohoo. So I'm sure a lot of you guys are familiar. I'm sure women on the website on this webinar will be familiar with Boohoo, which is an online clothing company. I think they've only recently started doing a men's range. I can see the adverts all over the buses and on the underground. Here you go, guys. Why would I be fixated with the euro dollar when Boohoo has been a very profitable stock for me? Logic is exactly the same. It's above the 50. Because it's quite a new stock, the 200 hasn't started plotting itself, but it's above the 50. And if we look at the daily chart, above the 200 and above the 50. Exactly the same logic. After every move, the market consolidates. A breakout above this high will allow you guys the opportunity to start entering back into these, or to start entering long positions into this particular stock. Okay, I think that is me for today. Are there any final questions there, Simon?
Yeah, Zaheer, there's lots of questions. we're not going to get through them all. I'm afraid, everybody. I wanted to let Zaheer finish his point there, but we do have a couple of minutes. Let's just make a stab and see how much we can get through. Marin says, can you just explain again what these moving averages are? And I think this is a similar question to two other people have asked.
Yeah, sure. So moving averages are simply a smoothing of price over a number of days. So moving averages are calculated using the closing price as a standard of each bar. That closing price is taken into a mathematical formula, and that then gives you the average over the last 50 days for the blue line and 200 days for the black line. And as you can see, price has this random movement to it. It's heading up, but there's this random pullback movement to it, whereas the moving averages are very smooth. So they smoothen out price, and they are used to A, as support and resistance, proven levels, and B, they're used to confirm what price is telling us.
Okay. The technique for entering into a pullback,
Yes.
what is it?
What is? Okay, is that the question?
Yes.
Okay.
Sorry.
Yeah. Good question. My advice, guys, is don't get fixated with pullbacks. Get fixated with breakouts. If you think about it, let's get the pen. Breakout, 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 breakout. How many of these would be pullbacks that you would want to trade? The only real good pullback I would see is this one pullback here, because it's pullback to a round number. So I would say don't get fixated with pullbacks. Pullbacks require experience. I know that you go on the internet and people say you make more money from trading pullbacks. You don't. You make more money from trading breakouts, because breakouts confirm the trend. Pullbacks require more experience.
Okay. The previous year's support and resistance levels are the standard features of e-signal.
Yeah. So the pink lines are actually something that you guys should be aware of. Is a tool that was developed by Dynamic Trader, but the Dynamic Trader allowed eSignal to provide it as a standard tool. But it's the Dynamic Trader that actually created the pink lines.
Okay, wonderful. If you're in a long-term trade, how often do you need to check it? Asked Deborah.
Yeah, a really, really good question. My routine is I do an hour of preparation at the weekend, and that's when I use my scanning tools. I've got scanners, I've got a whole load of tools that will scan the market for me. That takes about an hour. I build a watch list, and then Monday to Friday takes me no more than 10 minutes to 20 minutes a day.
Okay, fantastic. Here, I think we're going to have to draw it to a close.
Yeah. Can I quickly direct people to social media?
Yes, please, if you do that. And while you're doing that, I'm just dropping your email address into the chat box again for
Brilliant.
people to email Zaheer, and he will send you back by return the ebook where a lot of this information's contained. So
Correct, exactly. So beyond the ebook, guys, as I've already mentioned, there's training involved. I've got a training course which costs £99 for a whole month of training. It's online. You've got strategies, community support, FX training, stocks training. If you go down the route of getting eSignal, you'll get access to some of our tools. There's weekly webinars, just a lot of information that goes into it. It costs £99 plus VAT if you're in Europe for a whole month. Beyond that, if you want one-to-one training, then we can talk about that. But this is a great place to start for most people. Connect with me on Facebook. So just search for my name. I've got a Facebook page as well called City Trader Lifestyle. I'm on LinkedIn. And if you're on Instagram, fx.mentor, search for me on Instagram. I'm on Twitter. Oh, and something that I would recommend you guys, please, if you are or if you're not, is to go to medium.com and to search for my profile. And I have lots of articles going up on my blog site. So please go to Medium. It's a company owned by Twitter, and it's where I do a lot of my blogging. Thank you, Simon.
great, thank you, Zaheer. And do you receive any letters? Have you got an address for people to post a letter to you?
I would rather they emailed me, if I'll be honest with you.
The postal strike's not affecting you there. Great.
Yeah,
Zaheer and
yeah.
Anwari, thank you very much. We're going to go and
Brilliant.
take
Thank you.
the presenter role back. Thanks again.
Thank you.
I know
Thanks
you're
again, Simon.
suffering.
Take care, guys. Bye-bye.
Suffering.